Everyone, in this presentation we are going to talk about margin trading. So what is margin trading? What margin trading is the method of buying stock without having the entire money to do it. It is a method of buying shares that involves borrowing a part of sum needed from the broker executing the transaction. So what happens is that you have 1000 rupees, but in market there is a facility, margin trading, which is provided by the broker. So broker says that for you there is a margin requirement of 10%. So with that 1000 rupees you are able to buy shares worth of rupees 10,000. So 10,000 worth of share, 10%, 1000 rupees you give as margin for buying share rupees 10,000, and these 9,000 rupees are given by the broker. So it is a form of investing in the market where the actual price of you do not have to invest the actual amount of the stocks that you are going to buy, just a minimum percentage of it that you have to maintain in your account with the broker, and the rest of the money is invested by the broker. So generally the margin, there is a collateral that you have to be kept for that margin. So the collateral for the loan is normally securities in the investor's account. The collateral, the investor must deposit an initial amount of cash, this is the margin, into the margin account with the broker, and can purchase stock worth more. But there is a one requirement that you have to maintain a minimum amount of cash or securities as collateral in the account. Whenever the cash or securities goes below the minimum amount, the broker would square off your position. He would sell off the shares that you are holding with the amount of the margin. So you have to keep maintain minimum amount of cash or security in the. So what is margin trading? It is buying stock without having the entire money to do it. You just invest a part of the money, which is obviously given by the broker, the percentage of margin, and the rest of the money is provided by the broker, and you invest in it, and all the profit and losses that happens in the trade is adjusted according in your account only. The broker has nothing to do with it. So the broker charges interest on this loan. The investor has to keep the entire stock holding with the broker as collateral. All the stock holding is as collateral with the broker. But however, you have to understand one thing in this case, that margin trading is a double-edged sword. It is a risky affair. If the stock prices, yes, you would make a hell lot of a profit, great profit with much less money. You are able to get a high profit with very much less money investing. But if the price falls, the loss is also very high. So in normal trading, it is much more riskier as compared to normal trading. So we are going to talk about that in the later slides. Now from this pie chart we can see that there is a large amount of borrowing capacity available in the market. So if you do the normal trading, you are not able to get the benefit of that borrowing capacity. You will invest your own money, and you will have to get return on that money, and you are not able to get the total benefit that can arise from that money. You are not able to what I would say, that the actual benefit that rupees can generate, that the amount of money can generate, you are not able to get it. But if you do margin trading with a 10% margin trading, so borrowings that you will take for investing in the market, you would be able to get the actual benefit of the money that you will be investing as margin. So this pie chart shows the same. In first pie chart with normal trading, you have around, if it is a 10% margin trading, you have around 90% of that money unutilized. However, if you do margin trading, you have borrowings of that 90%. So now we would take an example of both the cases, normal trading and margin trading, and we will tell how the returns are magnifying returns. How the returns in both the cases are magnifying in margin trading. So in normal trading you can see that suppose we have rupees 1000 rupees, we have 1000 rupees that we have to invest in the share market. So in first case, in normal trading, we are able to buy purchase an asset of rupees 1000 rupees with the amount that you have. So it is self finance, we do not borrow any money, and suppose the return on that money on that day in the share market is 20%. So the return would be 200 rupees, absolute return would be 200 rupees, and the rate of return, if we calculate from the amount that we have invested, so 200 rupees of 1000 rupees, it will be 20%. And the net value of assets, which is the purchase price of the asset plus minus the loss or profit that the investor incurs, would be 1200. But if we see the case of margin trading, you will be able to see magnifying effect. So with you have rupees 1000 rupees, but you will be able to buy shares worth 10,000 if the margin requirement is 10%. So in this case, the purchase price of asset is 10,000. You have self finance 1000 rupees out of that 10,000 and borrowed 9,000 from the broker. Suppose the same return happens 20%. Here your return, absolute return, will be 2000 rupees instead of 200, because here the purchase price of the assets are 10,000 instead of 1000, because you have taken a loan of 9,000. And if we see, the rate of return is 200%, 10 times more than the normal trading. So with a margin of 10%, you will be able to get a return of 10 times more than normal trading. However, the possibility of loss is also very high. You will be able to, if the value fall by 20%, you will be able to lose 10 times more than the normal trading. We will talk about that later. So here the net value of asset would be 3000, much more than what there was in the normal trading. So you can see from this example, a simple normal example, that how the leverage, that is the borrowing, can have a magnifying effect on the returns of the investor. So with the margin trading, you can earn way more as compared to normal trading, and you can lose way more with L1. So I'm going to take the same example and would tell you how it's a risky affair. So in this case, you see that there are two cases. One case, stock price rises, and one case, stock price falls. So the first case is the same as taken in the previous slide. The 10,000 rupees invest, out of which the 1,000 rupees is self finance and 9,000 is taken borrowed. The change of value is 20%. So the return would be 2,000, and you would be able to get a rate of return plus 200%. It's very high. But if the stock price falls, here the game changes. You have 10,000 rupees, out of which 1,000 is self finance and 9,000 is taken as a loan. So, and same loss, there's a 20% loss in the market. In that case, your return, absolute return, would be 2,000. Rate of return would be minus 200%. So you can see the range of losses. It's very high, and the net value would be minus 1,000. Yeah, that which means that you have to give 1,000 rupees to the broker. So one thing you have to be taken care in the margin trading is that all the risks and the returns are borne by the owner. Hence, whatever be the effect of the return on the overall investment, it is to be absorbed solely by the capital invested by the owner. Okay. So if there is a profit, it increases the value of money for the owner, and if there is loss, it's also borne by the owner. The broker does not have any right on the returns, or does not borne any risks. All the risks and the rights of the return lies with the owner only. So you can see that when the prices rise, you have a magnifying effect on returns. Similarly, when the price falls, you have a magnifying effect on losses also. So this must be taken into care while doing margin trading. because if there is a chance of earning more, yes, there is a chance for losing more. So we can see there is a large buying power also in case of margin trading. So if you say you have to buy 2,000 shares of a company, say A, which trades at rupee 300, you will need 6 lakh rupees to buy that 2,000 share. But if your broker is providing you margin facility, then in that case, and the margin facilities is 15%, then by investing rupees 90,000, you will be able to buy 2,000 share, which is worth 6 lakhs. So it increases the buying power of the investor. And the margin funding depends upon the broker and client relationship and the regulatory authorities, that they also set sometimes the margin requirements. And the broker generally uses his own money, which he gets from credit from banks, and keep the share in his account. All the shares is keeping in the account of broker only as a collateral. So whenever there is a change in the losses and you are not able to keep minimum amount in the balance, he would square off your position. He would sell out the position. Sell. So in India, how margin trading takes place? So in India, margin trading also refers to intraday trading. So in India, if you wanted to do margin trading, you have to buy and sell share in the same day. In India, margin trading is allowed only on intraday purposes. In same day, you have to buy the shares or sell the share, short selling, and you have at the end of the day, in between the day only, you have to sell the share or buy the share. So margin trading in India involves buying and selling of security in one single session only. The process is fairly simple. A margin account has to be opened. Under this margin account, it provides you the resources to buy more quantities of stock that you can afford at any point of time. For the purpose, the broker would lend the money to buy share and keep them as collateral. So he would lend you the money to buy the shares and keep the securities as collateral with him. So in order to trade with a margin account, you are first required to place a request with your broker to open a margin account. This requires you to pay a certain amount of money upfront to the broker in cash, which is called the minimum margin. So this cash that you deposit with the broker is the minimum margin that has to be required. This would help the broker recover some money by squaring off should the trader lose the bet and fail to recuperate the money. So if in scenarios where the stock price start to fall very heavily, in that case, if the margin is not able to fulfill, margin amount is not able to fulfill the losses, so that losses would be recovered from that minimum margin account. That margin account, the minimum margin you have given to the broker, that is from there it would be recovered. So once the account is open, you are required to pay an initial margin also. This initial margin is the 10% and 15% which we were talking which we are talking in the presentation. So it is a certain percentage of total traded value predetermined by the broker. The broker would determine you have to pay 10%, 15%, 20%, 30% of the total traded value of the shares. So before you start trading, you need to remember 3 important steps. There are 3 important steps in margin trading in India. First, you need to maintain the minimum margin through the session, because on a very volatile day, the stock price can fall more than one had anticipated. So example is also given. So if a Tata Steel stock priced at rupees 400 falls 4.25%, okay, the initial margin and the minimum margin are 8% and 4% of the total value of the shares bought respectively. Then the trade-off would be 8% minus 4.25%, 3.75%, which is less than the minimum margin. So in this case, you either have to give more money to the broker to maintain the margin, or the trade will get squared off automatically by the broker. So you can see that in this case, what is happening is that the loss incurred by the investor is more than the initial margin, that is more than the minimum margin, is more than is more than the minimum margin that has been set. So uh, when uh, when the losses is recovered from that initial margin, the amount which is left is less than the minimum margin, and you have to maintain a minimum margin in the in your account. So as a result, in this case, so you have to give more money to the broker in order to maintain the minimum margin, or else he would sell the share and would charge you, and would recover his money from by selling the shares, and all the profit and loss would be transferred to your account. He would charge all these things from you. So so it is necessary to maintain the minimum margin and initial margin, minimum margin throughout the session. Initial margin you have to pay. So second, you need to square off your position at the end of every trading session. So as earlier said, it's a intraday trading. It's not something that it's not a trading, long-term trading, or you can buy a share for one day and you can sell after 1 week, 1 year, 1 month. No, it's not. It's intraday trading. You have to buy and sell in single session. So you need to square off your position. Square off means selling of the position. It mean you do not have any holding at the end of the day. So you need to square off your position at the end of every trading session. If you bought shares, you have to sell them, and if you have short sold it, which means sold it, you have to buy at the end of the session. Else the broker will do it. Broker would square off your position. However, he would not see the deal. He would not see whether you are getting a good deal or a bad deal. He would square off the position at which the orders are placed. So if the you can get a share price, or you can sell a share at 360. However, people have placed order with the broker to buy share at 340. He would sell share at 340 because orders are there. You have to complete the orders. Thirdly, convert it into a delivery order after trade, in which case you will have to keep the cash ready to buy all the shares you had bought during the session, and to pay the broker fees and additional charges. It's not very important. So it is after the trade. If you want this, it is to convert into a normal trade, you have to keep your money. You have to keep cash ready to buy all the shares that you had bought. So in that case, you will get the holding of the shares, and you have to pay the broker fees and the adjustment. What happens is after the trade is completed. So as earlier I told, if you have buying share worth 10,000 by giving rupees 1,000, that is 10% margin. So what happens is that if you will get a profit of 20%, you earn 2,000 rupees on that 1,000. So that 2,000 will be transferred to your account at the end of the day, and your position would be squared off. Okay, so whatever the loss and the profit that you earn is adjusted from your minimum margin and your initial margin. So if you earn loss, if you incur a loss of 1,000 rupees in the day, then your initial margin that you have earlier used to buy the share of 10,000 rupees would be adjusted from 1,000 rupees. So the profit or loss that the investor make in the trade is adjusted with the margin provided by the investor. So if the investor incur loss, that money is deducted from the margin account, and if it makes profit, it is added to the margin account, and vice versa. So this is how the process. This is how margin trading takes place in India, and you have to remember this, that it is always intraday in India. Margin trading is allowed only intraday. So one more thing that I would like to talk is that while buying futures, derivatives, there is a facility also provided to buy it at margin. In futures, you can also buy it for margin. So margin trading is different from futures. First, in India, margin facility is available on both normal buying and selling of shares, and also on futures. However, margin trading, as I have already told you, is only applicable on intraday of trading. Okay. Also, there are certain shares which do not have futures. So in that case, you cannot use margin to buy futures. You have to do, if you are willing to go for higher risk appetite, you have a higher risk appetite, you can only do margin trading. In that case, you cannot buy futures on margin. And generally what happens is that when you buy when you generally go for a stock purchase, the margin that you use is used to buy partial equity of the stock position, and the balance of the position is as a debt, and you owe the balance. That is, if you invest rupees 1000, so 9000 is of and you invest rupees 10,000, so 9000 rupees is the debt you owe, and 1000 rupees is your own money. But in future markets, a margin acts as a security deposit that protects the exchange from default by the customer or the brokerage house. It acts as a what I would say security deposit, so which helps the customer, which helps the exchange to if in any case there is a default made by customer or brokerage house, it can use that money to recover their dues. So this is what margin trading and futures are different. And also futures are different things, they are derivatives of instrument, and margin trading is done on normal buying and selling of shares. Okay, so this ends my session on margin trading. So I hope you were able to understand what margin trading is, and I would say again this thing, that it's a risky affair. If you have a high risk appetite, then you should go for margin trading. But if you are not such a risk loving person, then I think it must be avoided. Okay, thank you very much.